Welcome to our tutorial series on the Executive Compensation 457B Plan for Tax-Exempt Co-ops, presented by the Homestead Fund's Deferred Compensation Consulting Team. A key part of administering your co-op's 457B plan is managing contributions by the participant to the plan. To help you understand this process, we will review the following: key administrative tasks involved in managing these contributions, the limits on contributions, the availability of special catch-up opportunities, and then finally some information about tax withholding and reporting responsibilities. These are all activities that are performed by the co-op as the plan sponsor and administrator. But of course, Homestead's Deferred Compensation Program team is always available to assist as needed. First, let's talk about some of the key tasks related to administering contributions to 457B plans. When co-op participants, either employees or directors, enroll in the plan, they must complete a deferral election form where they specify either a dollar amount or a percentage of pay that they would like to defer into the plan. Deferrals may not begin any earlier than the month following the month on the form. So, for example, if a participant wanted to start making contributions in June, the initial deferral election form must be completed and submitted to the plan administrator at the co-op no later than May 31st. These forms should always be kept in a safe and easily accessible place in the event of an audit, but also so that the next plan administrator can easily find them. For more information on the process of adding participants to your plan, you may wish to view the session entitled Enrolling Participants. 457B employee and director contributions are processed through your payroll system in a very similar fashion to the 401k deferrals. Funds are immediately vested in the plan, so all payroll taxes, Social Security and Medicare, must be withheld at this time. For directors' plans, the deferral amounts are withheld from directors' fees. Since directors are independent contractors, no payroll taxes are withheld. Instead, directors are responsible for paying the associated self-employment taxes. Once the deferrals begin, they are transferred by the system you've set up with Homestead to the participants' earmarked accounts. Typically, this happens by a systematic ACH transaction, or alternately by check or Fedwire. If you haven't already, you may wish to review the tutorial on setting up investment accounts for further information. Finally, it's very important to have a system, typically with payroll coordinating with human resources, to monitor and track contributions. This help ensures that actual deferrals match the participants' deferral election, and it also helps track annual contributions from the employee plus those from the co-op, so total contributions do not exceed the annual maximums. Unlike 401ks, any employer contributions to a 457B plan do count towards the annual maximum amount. Having a system also will help you document contributions over the years, which will provide the information then needed to determine a participant's eligibility for the plan's special catch-up provision, which we will discuss in a minute. We've previously referenced the annual limits, so let's talk about them for a minute. Like the 401k plan again, 457B plans are subject to IRS contribution limits that are typically adjusted annually. You'll find the current benefit and contribution limits on homesteadfunds.com. As mentioned previously, unlike other plans, the participant and the employer contributions are contained in the overall limit. So, if the limit is $20,000 and the employer puts in $10,000, the participant can only do an additional $10,000 deferral into the plan. Excess contributions can be an issue for 457B plans, so it's the responsibility of the plan administrator to ensure that the limits are not exceeded. To avoid any over-contributions, we suggest setting up some sort of automatic cutoff in your payroll system, if at all possible. If an over-contribution does accidentally occur, the plan must refund those excessive deferrals plus any earnings associated with it by April 15th of the subsequent tax year. If over-contributions are not removed by April 15th, unfortunately, the IRS does not have any further provisions for corrections. And in this case, the plan could be deemed out of compliance, which means that all plan assets of all participants would become immediately taxable. So as you can see, it's a very important process to have in place and to carefully track each participant's contributions annually. There is a catch-up contribution amount available in 457B plans, but it is not a flat amount beginning at age 50 like we are all familiar with 401k plans. Hopefully this message is getting through loud and clear on the slide. However, since government 457B plan rules do allow age 50 catch-up, this often causes confusion with plan participants and plan administrators. The plans we're discussing here are tax-exempt plans, not governmental plans, which are set aside only for municipalities and public power districts. So if you have a tax-exempt 457B plan, there is no age 50 catch-up. The catch-up that is allowed is referred to as a special catch-up, which allows for a participant to catch up on previous year's contributions. Perhaps a more descriptive term is make-up, because additional contributions are allowed only if a participant did not contribute the maximum amount allowed each year he or she was eligible to participate in the plan. The amount a participant can make up is determined by the total annual maximum allowed during the time period when they were participating, subtracted from the total amount the participant contributed during that same period. So let's review an example. For this participant, he or she was eligible to participate in the plan in year 1. In that year, the maximum contribution allowed was $18,000. The participant contributed only $10,000 that year, leaving $8,000 in potential catch-up. In subsequent years, he or she also under-contributed, leaving a total of $25,500 in unused deferrals that could be made up as part of the special catch-up process. So if you look at the chart, the maximum he or she could have contributed over that 3-year period was $55,500. The participant only contributed $30,000, $10,000 a year, leaving a potential for catch-up of $25,500. Let's discuss some specifics. This make-up amount can be used during the 3 years prior to, but not including, the year a participant reaches normal retirement age in your co-op's primary pension plan. For example, if your plan's normal retirement age is 62, then catch-up occurs in the years the participant turns 59, 60, and 61. Another date may be designated in advance by the participant as long as it is later than the original normal retirement date, and as long as this change is allowable under your plan provisions. For example, an employee may participate in an age 62 RS plan, but plans to work until age 65. They could then designate age 65 after the actual NRD of age 62, and then use catch-up years for the years they turned 62, 63, and 64. However, under no circumstances, no matter how much makeup is available, and again, you must have makeup available, the participant can't have maximized their contributions each year they were in the plan. No amount of contributions in those makeup years can exceed up to 2 times the annual limit for the given year. So let me say that again. You must have underutilization, meaning the participant hasn't always maxed out their contributions in each year they were eligible. And if there is makeup amount, it can be spread over those 3 years, but under no circumstances can each individual year amount to more than 2 times whatever the annual contribution limit is in effect at the time. For further details on calculating special catch-up amounts and to walk through a detailed example, please review the 457B participant guide or view the special catch-up contributions tutorial. And finally, no discussion on contributions would be complete without addressing the issue of taxes. As participants defer income into the 457B plan, tax withholding for employees is very similar to 401k contributions. Payroll taxes, FICA, Social Security, and Medicare, are withheld, but income taxes are not. These contributions show up in Box 12, Code G of each employee's W-2 form. For directors' 457B plans, because they are paid as independent contractors, no tax withholding by the co-op is required. The full amount of director income earned is reported on IRS Form 1099 NEC, or non-employee compensation, and it is solely the responsibility of the director to pay their self-employment taxes and to report any 457B plan deferrals on their own tax returns. Thanks for reviewing the basics of executive compensation 457B plan contributions. Be sure to review the Administration of Special Catch-up Contributions tutorial to learn more about this important provision. And remember, Homestead's Deferred Compensation Program team is here to help you with this and other topics. Feel free to send us an email or give us a call. Thanks for your time.